IFRS 3 defines a business combination as a transaction or an event wherein an acquirer acquires one or more business, which is the acquiree. So the acquirer acquires the acquiree, okay? So basically it obtains, or the keywords, it obtains and it takes control of the acquiree. So why do we do business combination? So there are actually increasing trends to expand operations of the business. For example, the parent company, that's why they acquire businesses through business combination. So rather than internally expanding their business, they would rather externally expand their business by acquiring another business. This development is largely due to the effects of recession, then we have inflation, and then we have continued uncertainty over the ability of the government to control economic ills. With business combination, both the companies will utilize common facilities and also share fixed costs like employee salaries. Also, this may be undertaken for the possible tax advantages available to the acquirer. So, what is a business? Sometimes, not all assets and liabilities that are being acquired by acquirers are actually a business. Sometimes it's just a set of assets and liabilities. So, a business is something that creates output due to input. So a business is an integrated set of activities and assets that is capable of conducting and being managed for the purpose of providing a return to the owners. So you have something that creates, there should be something that creates the output or the services. So the output is the product or the service. So for example, if it's a manufacturing company, the input is the equipment or the machinery. And then the product would be anything that is being created by the equipment or the machinery. And also, it could be in the form of the cash flows. So, the money received because of the product and the services. Okay, so I will give you one example of a business combination. So, for example, we have entity A. Entity A acquires entity B for 100 million. This is the cash consideration given. Cash consideration. So, how much is the assets and liabilities of entity B? So, for the plant, we have $100. Machinery is 50. Equipment is 20. And mortgage is 90. Okay, so how much is the net assets? Net assets is equal to assets less liabilities. You don't include equity here because equity is basically equal to net asset. So 100 plus 50 plus 20 minus 90 is equal to 80. So the net asset is 80 for entity B. And then for C company, for entity A will employ the employees of entity B. A is the acquirer and B is the acquiree. Okay, so A will continue to employ the employees of entity B, and the plant is a CGU, generates cash flows. Okay, then for the second problem. For a C company, we have the plant for $60 million, and then we have machinery for 20, equipment for 20, and the loan secured on the factory, which is 50. Okay, how much is this? So this is the net asset is again A minus L, which is 50 million dollars. However, entity A will retrench the existing employees of entity C. So this means that they will not continue employing the employees of entity C, and the set of assets is not capable of generating cash flows. So again, we said that the business must be able to generate it generates cash flows, right? Ability to have output. So there. So for this one, entity A is a business. Entity A, business. This one is not a business. So how do we solve for the business combination? So what do we do next? So first, how do we record for the transaction? So for entity B, remember entity B is a business. And then for entity C is not a business. Not a business. Okay? So for remember that entity A paid $100 million for the net assets of entity B, which is equal to $80 million. How do we allocate the excess? So the excess is the goodwill. What is the goodwill? This is the excess of the cash paid over the fair value of the net assets. Remember that the cash paid is 100 million and the net assets is 80 million. So we have to record goodwill because this is like the intangible asset which is like an extra, they call this like an extra asset for the acquiring company. So the cash consideration is 100 million less the fair value of the net assets, and then the goodwill is 20 million. This is an intangible and presented in the acquirers FS as goodwill. It's a debit, okay? We debit the goodwill. Then for entity C, entity A pays for 55 million. Remember, entity C's net asset is 50 million. So again, the cash consideration is larger than the net assets. So you have an excess of 5 million. But we don't record this as goodwill because goodwill is only recorded for businesses acquired or businesses that generates cash flows acquired. But for entity C, since it doesn't generate cash flows, only the excess of the cash paid over the net asset must be allocated to the assets of entity C. So what are the values again of entity C's assets? So the factory is 60, machinery is 20, equipment is 20, mortgage is 50, right? Since there's an extra 5 million, we do a proportionate share. So for example, entity A decides to allocate the 5 million based on the proportion of the total assets. So what is the percentage of each of these assets over 100%? So this is 60%, 20%, and 20%. You allocate 5 million by 60, so 5 times 0.6 is 3 million, 5 times 0.2 is 1 million, and 5 times 0.2 is 1 million. And you add this to the fair value of the assets. You add the allocation of the 5 million. You add the allocation of the 5 million to the value of the assets. Add the excess to the value of the assets. So 60 plus 3 is 63, 20 plus 1 is 21, 21. There you go. So these are the new values. This is how you allocate the excess of the cash paid over the fair value of the net assets if the set of assets and liabilities acquired is not a business or not a cash generating unit. So how do we consolidate these amounts to the acquirer's financial statements? So let's first look at the values of the acquirer's financial statements. So it's plant and factory costs in $1 million. Plant and factory is 200. Machinery is 100. Equipment is 50. Current assets is 250 with a total assets of 600. Then current liabilities 100, long-term loans 200, total liabilities 300, share capital is 100, and then retained earning is 200, and then equity is 300, with a total liab and equity of 600. So remember the formula: assets must be equal to liabilities plus equity. It must always balance. Now for the new FS, we add the values of the new business acquired. We add the assets of B and C. So for the plant and factory, what's the value? So for the plant and factory of entity B and C, plant is 100, and for entity C it's 63. So we take these values, 63 and 100. So we add this to 200, so that's 363. Oops. Sorry. That's 363. And then what about the machinery? How much is the machinery? For entity C, it's 21. Then for entity A, it's 50. We add the values of 50 and 21 to 100. That's 171. For equipment, how much? 21 for entity C. And then 20. So we add the values. That's how much? That's 91. And then the current assets. So current assets include the cash. So since we paid 100 for B and 55 for C, so we have to reduce our current assets by 155, resulting to a new value of the current assets of 95 million. So, and remember, we record the goodwill, right? We said that we have to record the goodwill of entity B due to the excess of the cash paid over the net assets. So we add an additional line item of goodwill amounting to 20 million. Now we have a total assets of 740 million. And then now we go to the current liabilities. It's the same since there's no addition to current liabilities. Sorry, it's not. We have an addition. And then for the long-term loans, For the long-term loans, we have this mortgage over here for entity C. We have this mortgage for entity B. So we add that to the value of 200. So that's how much? That's 340. That's 200 plus 90 plus 50. And then how much is the retained? How much is the share capital? Sorry. How much is it? The total liability is 440. And then share capital is the same. We don't record the equity. We don't add the equity of the acquirees. So equity is the same. Okay, so 440 plus 300. So it's equal. So that's the new value of the FS consolidated. Okay, there you go.